Right now, in this moment, there's a process happening in banks across the world that most people have never been taught. It is not complicated. It is not secret, in the sense that it is hidden in classified documents. It is openly documented in central bank publications, in economics textbooks, in Federal Reserve educational materials. And yet almost nobody knows about it, because it is never explained in plain language. And because if everyone fully understood it, the questions it would raise would be uncomfortable for the financial system. Here's what is happening. Every time a bank gives you a loan, a mortgage, a car loan, a student loan, a credit card advance, it does not go into a vault, pull out money that other people deposited, and hand it to you. That is not how banking works. That is not how it has worked for over a century. What actually happens is this. The bank creates the money the moment it approves your loan. It types a number into a computer. Your account shows a new balance. That money did not exist before. The bank created it out of nothing, digitally, right then. And then it charges you interest on money it created from nothing for years, sometimes decades, and you pay it back with real money. Money you earned through real work, real time, real effort. This is not a conspiracy theory. This is not fringe economics. This is the documented operational reality of the modern banking system. And it has profound implications for your financial life, for why prices keep rising, for why debt keeps growing, for why the gap between wealthy and everyone else keeps expanding. This video is going to explain exactly how this works, step by step, with historical context going back to 1913 when the system was formalized, and with the data that shows how this mechanism affects your purchasing power, your debt, and your economic future. Let's start at the beginning. What is money? This seems like an obvious question. Money is the thing in your wallet, the number in your bank account, the amount on your paycheck. But what is it actually? For most of human history, money was something tangible. Gold and silver coins, physical commodities with intrinsic value. If you had a gold coin, you had something real, something that required real work to mine and refine, something scarce, something that couldn't be created from nothing. The value was in the physical substance. Then came paper money. Initially, paper money was a receipt, a promise. You deposited gold in a bank. The bank gave you a paper note saying, this note can be exchanged for this amount of gold at any time. The paper itself had no value, but it was backed by gold that did. This was the gold standard system. Paper represented real gold. And the amount of paper in circulation was limited by the amount of gold backing it. This kept a natural constraint on how much money could exist. You couldn't create more paper than you had gold. Now here's where it gets interesting, and where the foundations of the modern system were laid. Even under the gold standard, bankers discovered something. They realized that most people, most of the time, didn't actually come to exchange their paper for gold. People used the paper, traded it, accepted it as payment. The gold just sat in the vault, mostly untouched. So bankers started doing something clever. They started issuing more paper than they had gold. If they had 100 ounces of gold, they might issue 200 or 300 ounces worth of paper notes, lending out the excess paper and collecting interest. The risk was that if everyone came to exchange their paper for gold at the same time, a bank run, the bank couldn't honor it. There wasn't enough gold. These early bank runs happened periodically throughout the 1700s and 1800s, causing financial panics, bankruptcies, economic crises. This practice of issuing more claims than actual reserves is called fractional reserve banking, and it is the foundation of the entire modern banking system. Now let's jump to 1913. This is a pivotal year. The year the Federal Reserve System was created in the United States. The Federal Reserve Act, signed by President Woodrow Wilson on December 23, 1913, created a central banking system for the United States, a lender of last resort, an institution that could provide emergency funds to banks that were running short. This did several things. First, it stabilized the banking system by reducing bank runs, because now banks knew they could borrow from the Fed if deposits were withdrawn suddenly. Second, it formalized and institutionalized fractional reserve banking. The practice of creating money through lending was now officially sanctioned and regulated. Third, it centralized control over money creation and monetary policy. The Fed could influence how much money existed in the economy by setting reserve requirements and interest rates. Now here's what the Federal Reserve itself says about how banks create money. This is not from a conspiracy website. This is from Federal Reserve educational publications. The Fed's own materials explain that when a bank makes a loan, it simultaneously creates a deposit in the borrower's account. Money that did not exist before is created. This is called credit creation or money creation through lending. The textbook description is that banks are financial intermediaries. They take deposits and lend them out. But the reality, documented in central bank research papers, including a 2014 paper from the Bank of England titled Money Creation in the Modern Economy, is different. Banks do not simply take in deposits and lend them out. They create new deposits when they make loans. Here is how it works step by step. You walk into a bank and apply for a $300,000 mortgage. The loan officer reviews your application, decides you're creditworthy, approves the loan. At that moment, the bank types into its computer system, new loan asset, $300,000. Simultaneously, it types new deposit liability, $300,000. Your account now shows $300,000, but no other account decreased by $300,000. No one else's savings were moved to give you that money. The bank created $300,000 in new money. Right then, by typing numbers into a computer, it is constrained by reserve requirements. It must hold a certain percentage of deposits as reserves, and it is constrained by capital requirements. It must maintain a certain ratio of equity to assets. But within those constraints, it creates money when it lends, and destroys money when loans are repaid. When you make your monthly mortgage payment, the principal portion of that payment actually destroys money. It unwinds the original creation. The interest portion is income to the bank. This system has profound implications. Let me walk through them carefully. Implication 1. The money supply is controlled by lending decisions. When banks lend freely, more money is created. When banks tighten lending, money creation slows. This means private institutions, commercial banks, largely control the supply of money in the economy, not just the government, not just the Federal Reserve. Private banks, based on their lending decisions, their profit calculations, their assessment of creditworthiness. This is why easy credit conditions, low interest rates, loose lending standards tend to coincide with economic booms. More loans being made means more money being created, more money chasing goods and services, rising prices, rising asset values. And tight credit conditions, high interest rates, tight lending standards tend to coincide with recessions. Fewer loans means less money creation, less money in circulation, prices falling or stagnating, asset values declining. Implication 2. Almost all modern money is debt. Think about this carefully. If money is primarily created when banks make loans, then money is essentially debt. For every dollar in your bank account, there's a corresponding debt somewhere in the system. Your mortgage created your home purchase money. Someone's car loan created money that went to the car dealer. Corporate loans created money for business operations. Government debt creates money through the bond buying process. The total amount of money in circulation is roughly equal to the total amount of outstanding debt. When debt increases, the money supply increases. When debt decreases, the money supply contracts. This creates an inherent pressure in the system toward ever-increasing debt. Because if debt were paid off, without new debt being created, the money supply would shrink. Economic activity would contract. This is deflationary. And historically, deflation causes economic crises. So the system requires continuous debt creation just to maintain stability, let alone grow. This is sometimes called the debt treadmill. You have to keep running, keep creating new debt, just to stay in place. Here is what most people never connect about their own financial life. When you take out a mortgage, you create new money. When you pay it back, that money is destroyed. But the interest you pay, that is new money that has to come from somewhere. It has to come from the economy, from other people's income, from other debt. The principal always destroys the money that was created. But the interest never had a corresponding money creation event. It has to come from somewhere else. This creates a mathematical pressure. The total debt in the system always grows faster than the money available to repay it, because interest charges continually add to what is owed, without a corresponding creation of money to pay them. This is why total debt in the economy tends to always increase over time, not because of individual irresponsibility, because of the mathematical structure of the system. Implication 3. Banks profit from creating money. Let us think about what this means for bank profitability. A bank approves your $300,000 mortgage at 7% interest over 30 years. Your total payments over 30 years are approximately $718,000. You pay the bank $418,000 in interest. On money, the bank created at zero cost. The bank's main input cost was not money. Money was created by typing. The bank's main costs are operational: staff, buildings, technology, risk management. These are real costs, but the core product, the money it lends, cost it nothing to create. This is an extraordinarily profitable business model. You create something from nothing. Lend it out, charge interest on it, receive back more than you created, and in the process, the original creation is destroyed while you keep the interest. No other industry has this capability. If you manufacture a product, you need raw materials, labor, equipment. Your inputs have real costs. If you provide a service, you need skills, time, resources. But banks create their main input, money, at essentially zero marginal cost. This explains why banking has historically been among the most profitable industries, not primarily because bankers are particularly talented, but because the system grants them the ability to create money and charge interest on it. Implication 4. This system drives inflation. Here's the connection between money creation and inflation that is rarely explained clearly. When banks create money through lending, they increase the total amount of money in circulation. If the money supply grows faster than the production of goods and services, each unit of money buys less. Prices rise. Inflation. From 1971 to 2025, the U.S. money supply, measured as M2, grew from approximately $700 billion to over $21 trillion, a 30-fold increase. Over the same period, consumer prices increased roughly 7 to 8-fold. The economy, measured in real terms, grew perhaps 3 to 4-fold. So money supply grew much faster than both prices and economic output. Where did all that money go? Into asset prices, stocks, real estate, financial assets. Assets that are primarily owned by wealthy people. This is one major reason the wealth gap expanded so dramatically over the same period. The money creation process inflated asset values, benefiting asset owners, while consumer prices rose more moderately, benefiting consumers somewhat. But wages grew less than either, leaving workers relatively worse off. This is where the system creates outcomes that most people feel but few understand. You work harder, you produce more, but inflation erodes your purchasing power. Asset prices rise, but you don't own enough assets to benefit. The money creation process, flowing primarily through lending into asset purchases, enriches those who already have assets to leverage, and slowly erodes the real wealth of those who primarily earn wages. Implication 5. Government debt and the system. The government also interacts with this money creation system. When the government wants to spend more than it collects in taxes, it borrows. It issues treasury bonds. In normal circumstances, these bonds are bought by private investors. That money goes to the government. The government spends it. The investors hold bonds. No new money is created in this process. Money changes hands, but the total doesn't increase. However, when the Federal Reserve buys those bonds, which it does during quantitative easing programs, new money is created. The Fed creates money and uses it to buy the bonds. This is sometimes called monetization of the debt, and it is a form of money creation through government debt rather than private lending. The Fed did this on a massive scale, approximately $4 trillion between 2008 and 2014, another $4 trillion or more between 2020 and 2022. This is a significant portion of the total money supply increase over recent years, and it is why the 2020 and 2021 stimulus period was followed by significant inflation in 2022. Roughly 6 to 7 trillion in new money was created. It eventually showed up in prices. Now, understanding all of this, how does it affect you personally? And what, if anything, can you do about it? This next point is what changes how you see every financial decision you make. Understanding that money is created through debt means understanding that debt is not just your problem. Debt is the mechanism of the entire monetary system. But that doesn't mean all debt is good for you personally. There is an important distinction between debt that creates assets and debt that creates liabilities. Debt that creates assets is borrowing to buy something that generates income or appreciates, a rental property, a productive business, education or skills that increase your earning power. In these cases, the debt creates something that can service itself and generate surplus value. Debt that creates liabilities is borrowing for consumption. Credit cards for daily expenses, car loans for depreciating vehicles, personal loans for vacations. These create no income stream to service the debt. You are paying interest on consumption. This is the most expensive way to consume, and it is how the system extracts wealth from people with limited financial resources. Banks are not villains for charging interest on money they create. They are operating within the system as designed. Their job is to maximize returns for shareholders. The interest income from money creation is how they do that. Understanding the system means not blaming the participants individually. It means understanding the structure and making personal decisions within that structure that favor you rather than favor the bank. Practical implications for your financial life. Number 1, minimize consumption debt. Credit card debt, personal loans for non-asset purchases are the most expensive forms of participation in the money creation system. You pay interest on money the bank created for free. This is pure wealth transfer from you to the bank. Eliminate this where possible. Number 2, understand mortgages honestly. A mortgage is the largest financial transaction most people ever enter. A $300,000 mortgage at 7% for 30 years costs you $718,000 total. You pay $418,000 in interest on money the bank created by typing. This doesn't mean mortgages are bad. Housing is a necessity, and ownership builds equity. But understand what you're agreeing to, and consider whether paying down principal faster when possible is worth the interest savings. Number 3, understand inflation as a feature of the system. Prices rising over time is not accidental. It is a predictable result of the money supply continuously increasing through lending. This means holding cash long term is a losing strategy. Your cash balance doesn't increase while prices do. Your purchasing power erodes. This is why real assets, things that hold value as money is created, tend to be better long-term stores of wealth than cash. Number 4, consider the assets versus liabilities framework. In the system where money is created through debt, people who own income-generating assets are positioned differently than people who only earn wages. Asset owners benefit when money is created because asset values tend to rise. Wage earners are neutral or slightly negative because wages often don't keep pace with asset price inflation. Building ownership of income-generating assets, however modest, changes your relationship with the money creation system. Number 5, be an informed participant. Understanding that banks create money, that the money supply constantly expands, that inflation is structural, that debt is the mechanism of money creation, gives you a fundamentally different understanding of financial decisions than the simplified version most people operate with. You stop wondering why your savings account erodes purchasing power over time. You understand it's designed that way. You stop wondering why housing always seems to get more expensive relative to wages. You understand the money creation process inflates asset prices preferentially. You stop feeling personally responsible for economic conditions that are structural. This is general historical analysis, not personal financial advice. But it is the foundational understanding that every financially literate person should have. And almost nobody is ever taught. The money trick that banks have been running since 1913 is not malicious. It is not a secret conspiracy. It is an openly documented system with real economic functions. It allows credit to expand economic activity. It enables people to buy homes before they save the full purchase price. It lets businesses invest before generating the profit to fund investment. These are real benefits, but the system also has structural consequences. Inflation is a permanent feature. Continuously growing debt, asset price appreciation exceeding wage growth, wealth concentration toward asset owners. These are not accidental outcomes. They are predictable results of how the system is designed. Understanding them helps you navigate your own financial life more effectively. It helps you vote for informed policy positions. It helps you have more realistic expectations about what economic conditions will persist. And it helps you stop blaming yourself for struggling in a system that is mathematically structured to extract wealth from debtors and deliver it to creditors. Subscribe to Decoding the Economy for more analysis of the fundamental systems that shape your economic life. Each video goes deeper into the mechanisms behind the headlines, the structures behind the statistics, the real dynamics behind the simplified explanations you normally get. This is Decoding the Economy, where we explain how the system actually works. Thanks for watching. See you in the next one.